Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I am Cameron Christensen, along with our co-host Anthony Faso, and we just wrapped up our interview with Steven Libman from Integrity Holding Groups. And I got to say, it was another really good podcast. Anthony, what are a couple takeaways you had here?
I think with our journey to financial freedom, right? Getting our passive income to be more than our expenses. One common way to do that is through real estate. What most people do, they start with a single family, and then maybe they start collecting a couple more, or maybe they get a fourplex. But ideally, they want to make that jump to an apartment complex. So instead of having, 10 different doors all over the country, but if you have that apartment complex, now you have 100 homes. So if there's one vacancy, it's not hindering the overall cash flow. And then you have that power of scaling. But so what he talked about is, how do you make that jump? And you can do that by either raising money or syndication. So I liked how he explained kind of what a syndication is, as well as how do you do it, and some pros and cons. So I thought that part was really good. How about you, Cam?
I will say that Steven had one of the most well thought out explanations of IBC that I've heard in a long time.
Yeah.
Right? In there, he goes into an explanation, and it was just a minute or so long, but coming from an investor's mindset, I was really impressed, to be totally honest with you. You were
amazing.
No, not amazing. you were speechless, and that doesn't happen very often.
That's true. That's true.
But also what I liked about his kind of story there was that he's just like everybody else, right? He shared the fact that when he first heard about IBC is that it didn't really click for him, right? Yeah. He thought it was for somebody else, right? He says he heard it say that it was for the really wealthy, and it wasn't until he kind of took the time to look into it and then actually apply it, did it really start paying off and paying dividends for him. And so, man, I really enjoyed that part.
What I think was interesting, he also said that it seemed harder than it really was. Yeah. Once he actually started doing it, it really wasn't that complicated. It's always good to get a different perspective, and really from people who are actually using IBC, to improve their investments. So that part was really good, and I think you're really going to enjoy this episode.
Absolutely. Take care. Steven, hey man, thanks so much for joining us. If you could start by telling some of our listeners, just give us a little bit of background of your experience, and also Integrity Holding Groups as well, and how you guys got started.
Sure. Well, I was born a long time ago. No, it was
going way back.
Going way back. How far back do we go? So I graduated Boston University 2004, went to college, wanted to go get a good degree, right? And I was always taught, go to school, get a good job, get a degree, earn money, save money, invest in the stock market, and then retire after about 70 years of doing that. So I graduated in 2004 from Boston University. I started working in Manhattan for about a year and a half, commuting from the Jersey Shore. It was a nightmare. I spent about a month out of every year on a bus traveling into a city to make a little bit of money. Realized that I could probably do more with my life if I stayed home, and got that 30 days back and started working for myself. I became a real estate agent first, and then a real estate broker. Started working with some family and brokering their office. Started making some money for some other investors while they were out looking for deals, and I was finding great deals for them. And I just told this story yesterday. I forgot about it. It was, I made this guy about $1 million in flips, in profit by finding him great deals. And at one of the closings, he held my feet to the fire for a $250 pool ladder that went missing sometime between inspections and this time. And I was just like, so I quit my job soon thereafter and decided I could do this myself. I can find good deals. I could flip houses. So we started doing some flips. Integrity Holdings Group was born 10 years ago. Myself and my partner, Travis, met. He trained my dog, if you could believe it. And we started having a couple conversations about real estate, and his family was in development. He was running underground machines. He was doing improvements like underground, putting sewers and water pipe and stuff in, running big machines. And we went down to Costa Rica for a couple of weeks and decided to come home and burn the boats. And we started Integrity Holdings Group, which was initially a fix and flip and wholesale business. So we started into real estate, and so we grew that business into a pretty significant business. We're doing over 200 flips a year. And we just actually had a meeting this morning where we have sold our last residential deal, and we are 100% now out of the residential, because as we have grown, we recognize that there's significantly more tax advantaged ways to make money and significantly less work. You can be more passive and make money doing what we call syndications, which is basically pooling a group of investors together. And now we buy apartment complexes and self-storage facilities. We've built a couple of those. So in just the past year, 18 months, we've acquired about $75 million worth of assets in Ohio and Florida and Iowa. And so that's kind of been the genesis. And now we're full-time commercial real estate operators.
So commercial, can you be a little more specific? Are these commercial buildings? Are they apartments or?
Yeah, so we buy two asset classes: apartment complexes and self-storage facilities.
Okay.
So we have we don't. Yeah, I know when I say commercial, some people think like industrial or retail or office space. We don't get involved in those asset classes. Part of our story is that my dad passed away about 6 years ago, and he lost almost half of his money in the stock market in the 08-09 crash. Didn't live long enough to ride the market back up like everybody else did. And that volatility made me really start to question whether or not mainstream thinking on Wall Street was right. And so being anti-volatility is kind of the crux of what we are. We're about capital preservation first. Return on investment is always a great conversation because we can get high yields in these types of deals. But the first thing is hedging downside risk. We want to protect the money that we've worked so hard to create first, and then go get a good return on it second. So in terms of volatility, apartments, multifamily housing, and self-storage are the two asset classes that win that debate. How so?
Would you mind explaining how they win?
Sure. Right now, we're in the middle of COVID. I don't know where you guys are at in the reopening process, but New Jersey is still lagging pretty far behind. I know quite a few owners here that are having significant issues with their retail shops, right? Nobody's open. So retail is taking a beating right now. We've been talking about the retail apocalypse for a couple of years now, and this might be the violent shove that it needed or that was coming. I read a report by Green Street Advisors that said 50% of all mall tenants will be out of business in the next 2 years. So retail is something that's a little bit more volatile. We stay away from that. Offices, same thing, right? People aren't going into the office right now, but everybody's still at home. Our occupancy, we still have 90% of our renters still paying rent on time. And self-storage in the 08-09 crash was actually the only asset class to increase in value during that downturn because people were losing their houses, they were moving, downsizing, and they needed a place to store what we call the macaroni art from our kids, right? We're all stuffing it somewhere, and storage facilities were the only asset class to actually go up 5% per annum during that time.
And what markets are you in? Did I hear you say that self-storage is in Florida? Is that what I heard you say?
Yep, we have 3 so far in and around the Orlando area. What we love about Florida is it's the second, Orlando specifically, the second fastest growing city in the country, and for the last 3 or 4 years. So it's got a big population boom happening. A lot of people are moving there. They have a high water table, so there's no basements, so people really need storage.
Interesting. I never really thought about that. But also, we live in Las Vegas where the ground is so hard. There really aren't basements. But that's a very interesting. I never put the two together, like the basement or lack of basement with the need for storage. Very interesting.
So, a lot of these national builders tend to build a 1-car garage. If you're lucky, you get a 2-car garage, right? So now you have 2-car garage, no basement. If you have kids and you have bikes and you have cars, and it's just you have limited places. Also, what's cool about, or what's interesting, at least about Orlando, is a lot of these communities are built with a homeowners association. So the homeowners associations don't allow you to store your boats, your RVs, your campers, or anything outside. So we actually have a large luxury boat and RV facility across from 1,193 units that we own as well.
Oh, wow, okay. And that's in Florida as well? All this is in Florida?
Yes.
So you guys, in the last year and a half, right, if I heard you correctly, was you guys fix and flip for 10 years, kind of transitioned into real estate. You've got your fingers in a couple of things in real estate, kind of self-storage, boat and RV, and then there was one other that you mentioned. But
the apartment complexes.
How have these opportunities come up? Did you guys set out and identify those and say, hey, I want to go to self-storage? It was an opportunity that presented itself, and then you guys moved on it. What was that transition?
So, if you listen to any commercial real estate podcast, Michael Blanc always talks about this, the law of the first deal. And it's difficult. There's a high barrier to entry to getting into, a $10, $12 million project. Our first passive income opportunity was not a single family rental. It was a $12 million storage facility.
Okay.
So we jumped in feet first, and we identified the markets we wanted to be in, the asset classes we wanted to be in. And we knew we could raise some capital, and we knew that we could help operate deals efficiently, but we were having this barrier to entry where I'd call brokers up and say, hey, this is what we want to do. And they asked us about our track record, and nobody cares that you're going to flip 200 houses this year. If you don't own an apartment complex or you haven't built a self-storage facility, you don't have the track record yet. So what we started to do was find some folks that were in the space and asking them how we could start adding value to them. And our partner, Sean, down in Florida, he identified the first, second, and third storage facilities. But the first one is where we kind of partnered with him and said, hey, we can bring value, right? We can help raise some capital into the deal. We can help with operational expertise. We can help in some different ways. And we partnered with an experienced operator, and we got into our first project, and the rest was kind of history.
Awesome. Just to remind you, Steven, you're just kind of sharing with us that you had partnered with, I believe it was Sean, and he had found you your first, second, and third deals down in Florida, brought you guys in.
Yeah, and then that kind of changes the dynamic, right? When we call brokers and we say, hey, we have about $50 million worth of these projects under our belt, and this is the next deal that we're looking for, it changes the tenor of that conversation. So that's really how we made the move into from residential into commercial. We always knew that we wanted to take that journey because we were getting killed in taxes, and we knew we wanted to get in, but we didn't recognize, I think, how difficult it would be to get in.
So that transition is, before we move on, is there any advice you'd give somebody? Because we work with real estate investors, and that's always kind of the ascension of the ladder that they want to work themselves through, is that wholesaling to the fix and flip, work their way up to commercial, right? What are some of the headaches? You just mentioned one of them, taxes, that you might be able to share with some of these guys.
Yeah. So, I think the fastest way to cut the line is going to be the way that we did it, which is partnering with an experienced operator, bringing value to that deal. And then you get paid to learn, right? So because we added value to that deal and we were part of the general partnership, then instead of having to go to all these classes and figure all this stuff out, we got to partner with a guy who's already been through it, and he taught us along the way. So being on the phone with lenders and being on the phone with asset managers and property managers and knowing what kind of things you're going through on day to day, if we had to learn through that ourselves, the learning curve would have been very steep. With this, it was, you're with an experienced operator, and they've already done it. He has $150 million of assets under management. So there was nothing new for him, and we got to learn through it. And after you go through it a couple of times, you start to recognize, like, this isn't rocket science, right? This is just, it's systems and processes and relationship. And that's, every business.
And I'm sure the involvement is a little bit different between the wholesaling business versus the commercial real estate. Can you touch on that a little bit?
Yeah. So, wholesaling is a very transactional business. It's a great active income business, but do not be fooled that you can you can wholesale your way to retirement, right? If you want to utilize the income that you make in this great active business and parlay it into something passive for retirement, then that's what you're doing, right? But you're not going to wholesale yourself to a couple $1,000,000 and then sit back and be done.
Yeah.
In my opinion, right? Maybe there are some guys that that'll speak up and say that they did that and they were able to do that. We were not able to do that. I mean, we systemized everything. We built a scaled business doing $3.5 million a year, and it was just not passive enough, right? And then we worked 40% of the year for Uncle Sam.
Yeah.
Right. I mean, we were in a very high tax bracket, very transactional. So it was one of those things that we knew we wanted to take the leap, because we started reading books like Tax-Free Wealth by Tom Wheelwright.
Mm-hmm. Great book.
Where you start to recognize that the government is incentivizing the people that it wants to incentivize to not pay taxes by doing these specific things. And the commercial real estate tax advantages are unlike anything else. I mean, we will pay zero taxes this year. I'm actually just did a webinar on this not too long ago. We're actually getting all the money we've paid back for the last 5 years in a tax refund, because we're taking the depreciation from the deals that we're doing this year. And the CARES Act with COVID is allowing for a 5-year net operating loss carryback. So my partner and I are getting multiple 6 figures back from the government as a tax refund because of the commercial real estate benefits.
That's unbelievable, right? One of the other benefits that the CARES Act provided, and we've talked about the CARES Act on our podcast before, and the opportunity that there is now for some clients to potentially shift some of their savings from kind of the highly speculative 401ks over to something that is a little safer and with more of a guaranteed return.
And that you control, right? I mean, so you guys, you know this, I use my life insurance policies in these deals. My kids do as well. So we have overfunded policies that we reinvest back into these deals. And right now is unlike any time else. It's a one-time get out of jail free card, right?
Yeah.
You can take $100,000 penalty free. And if you invest it in the right asset class with tax benefits, then it will also be a tax-free withdrawal, right? And then you can take another $100,000 out as a loan, and you have 5 years to pay it back. So if you think you can take that money out and do something with it beneficially, then you have tax advantages there, penalty advantages here. I mean, there's a lot of opportunity created by this CARES Act. The third one is that we just found out on a call with our accountant, who I invited on our show, was that the qualified improvement projects that we do, so CapEx for those syndicators that are out there, or capital improvements that you're doing for those people that are purchasing commercial property and then doing some kind of improvements to them, which we always do, right? We're buying these properties to improve them. So that is now 100% deductible. So before, when our average investor was saving 35% of their original investment on a K1 tax return loss, right? So $100,000 in, $35,000 loss on a K1, that's going to more than double for this year. So because we're allowed to take all qualified improvements and take them 100% in bonus depreciation. So, I mean, if you're not taking advantage of some of these things in the CARES Act this year, you are missing the boat. I mean, that's how we're getting all of our taxes back for the 5 years, by the way, is we're accelerating more depreciation. We're taking bigger write-offs this year, as the tax code allows now, and we're allowed to carry it back. So you start combining these things and it becomes very powerful.
One of the best videos, right? I checked you out and I was watching some of these things. One of the best videos that I've seen in a really long time is you did about a 10-minute video, and you were talking about some of the tax advantages between, I believe it was wholesaling and also commercial real estate. And you were touching on some of the things that you just discussed right there. For a 10-minute video, it had some of the best information I've seen in a really long time. So give these guys where they can find you on your podcast. And I'll see if I can go find that and send a link to it in the show notes. But it was one of the best videos I've seen.
Yeah, so the name of the podcast is Free from Wall Street. And, the name of the company is Integrity Holdings Group. And you can go to the YouTube channel if you want to watch versus listen. But they're in both places. The YouTube videos do have a couple extra things on there. I did a great one with my daughter, who's 6, called Millionaire Kids. And we basically tracked her $12,000 investment into our storage facility. And as that compounds and grows, when will she be a millionaire? So yeah, go check that out. And you can do a compound interest calculator to figure out how you can make your kids or grandkids or nieces and nephews millionaires. So stop giving savings bonds, right? Start investing and showing them.
Man, I love that. I watched that video, and my kids are 10, 8, and 6 right now. And I loved it, right? I mean, you could have titled that thing so easy, a 6-year-old can do it. you were interviewing her on this entire process, and she was tracking with you. She understood everything. She understood the fact that when it matures, she's going to turn around and reinvest it over again. It was a great video. Really good.
Yeah, thank you. She's excited too, right? She goes and tells her friends that she's in an investment and that she's getting passive income checks. We did another video with just a little update where she got her quarterly return. And, I kind of made a little joke at the end where it's like, is my 6-year-old, does she have more passive income than you do? If so,
that was a great question. Yeah.
Should really reach out to us.
Yeah.
Steven, you'd mentioned that how you're practicing like the infinite banking concept and using your policies to invest. Would you mind expanding on that a little bit more on how you've used it?
Yeah. So, when you start going down the rabbit hole of learning how money works, you talk about capital preservation, number one, return on investment, hedging risk, right? And then also how to grow it and accelerate that. So what the infinite banking concept does for us is it pours gasoline on the fire, right? We get to put money into a very tax advantaged, right? It grows and distributes tax free through your infinite banking policies. And then you get the double benefit of it grows with a dividend paying policy. So it's growing that way. And I get to borrow against it and put it into these projects that we're doing, right? So for example, let's say I overfunded a policy by $100,000 since I can pull it out of my 401k tax penalty free right now. Overfund that policy, right? You guys, it depends on who you're working with, but you can get out 90 to 95%, maybe even 100%, depending on your situation, right? Of that policy cash value. And then you go and invest it somewhere. And because of the flexibility that the infinite banking concept offers, where you don't have a scheduled payback period, real estate deals are really perfect for this because you don't have to make monthly payments or quarterly payments. Even though you're getting quarterly checks as an investor with us, you don't have to pay those back. So you can kind of wait until the thing matures until you pay it back. So most of our deals we're holding for 5 years. So I'll take $100,000 that I took out of my 401k, I put it into a policy, borrow against that policy, and I put it into a project like our self-storage facility, which is making over 12% per annum, right? So now that money is compounding in two separate places. One, it's tax advantaged. Two, it's protected, right? Asset protection is a big deal when you start talking about how these policies are protected from bankruptcy and sickness and all these different catastrophic things that happen in people's lives where they lose their money, injuries, right? Personal injuries, stuff like that. So yeah, it's not as complicated as I first thought when I heard it. Because I heard these guys talking about like, all right, well, this is for super wealthy people. And that's what I heard, right? What he said was super wealthy people do this. What I heard was it's only for super wealthy people. So I didn't necessarily jump into these policies right away, which was a mistake. Because once I figured out that I could leverage these policies to do two things. One, if you're paying off debt service, you can pay off debt service much quicker and save yourself hundreds of thousands of dollars in interest. When you get to the investment side of life, then it actually pours gasoline on your return on investment, right? Because your money is growing over here. And I think we did a calculation with you guys. It's like 140% on your investment if you do it through one of these policies because it's protected, it's growing. And the money that you take from your distributions, once you put it back in your policy, you get to start playing with house money eventually, right? So you're playing with, when I say house money, I mean interest dividends that you've already paid that wasn't your initial investment. And that becomes a big deal too, because when you get to use other people's money or interest that you've created using your own, then you really start to compound.
Phenomenal.
It's like drinking from a fire hose. You start talking about how to play a little bit of chess with the CARES Act, infinite banking concepts, and real estate. And you will watch your net worth just skyrocket. 10 years of wholesaling, we'll get back to the question you asked before, which was, how's it different? 10 years of wholesaling, we made money, right? I made a paycheck, but I didn't build my net worth. And your net worth, why that's important is bankability, right? That's the creation, preservation, and passing on of generational wealth, which is really what the focus is of our business, helping other people do that. And it's just, we were ignorant to it. We didn't know what we didn't know. We weren't taught it in our households, like most people are not. It's not taught in schools, right? I mean, Kiyosaki says this the best, right? You go to school, get a job, work hard, save your money, put it in stocks, bonds, mutual funds, and ETFs, and hope. And hope is not a strategy, and we saw that firsthand when my dad passed away, and we decided to take control of our financial futures and try to teach people along the way that they can as well.
Well, that's awesome,
man. One of the things you said in there is there's a lot of it's funny, right? Is we've just kind of recently became acquainted with each other, and one of the things you said was how to create generational wealth through commercial real estate, and that's what Anthony and I talk about all the time, right? That's what you're using this idea of IBC is to create generational wealth, and what's awesome is right bringing those two vehicles together, and that's when you get kind of that exponential growth, and like you said, just throwing gasoline on the fire.
It's how you truly create infinite wealth, right?
Yeah.
So if we're creating infinite wealth, then that means it can't stop. So how do we perpetuate that? And through the generations is how we're going to be able to do it.
Exactly.
I mean,
teaching our kids, right?
Yeah. And it's just these simple concepts that you can apply yourself that maybe you weren't taught, and that's okay. I mean, if you weren't taught it, you can still learn it. And once you start to apply it, you can start to see why, wealthy families are utilizing these strategies and how you can really do it. I mean, the big heart behind our business, right, is not to just create generational wealth for us, but for other people. And, so our tagline is invest with purpose. We carve out an equity position in every single deal that we do for a nonprofit, because
cool.
It's so difficult for people to go out and stop the mission so that they can go and raise capital, right? Because these 501c3s and these nonprofits are constantly in capital raising mode so that they can go and complete the mission, right? I want passive income for me and my family, but I want passive income for them as well so that they can have some reliable source of income that will fund their mission or their ministry for the next 5 years, and they can count on that. So when you start talking about infinite, right, I always think about infinite, eternal. How do those things juxtapose? And when you get to give infinitely, right, then I think you start to really have massive success.
Perfect. Well, we had talked about creating passive income, right? And I think we both follow Robert Kiyosaki. Our goal is financial freedom, passive income to be more than your expenses. And you started off wholesaling, which I know there's a lot of people do. That is very active, right? So a lot of people may start out there trying to build some capital, and then they buy single family, and then they might move up to a fourplex or have multiples, and then everybody's trying to get that jump into more of the commercial and apartment complexes, and that is a huge jump. Right. So you guys did it with raising money, and I know another way is through syndication. So would you mind taking some time and explaining what syndication is?
Yeah, I mean, basically it's many hands make light work, right? We're going to pull together resources and talents and capabilities, and we're going to share in those deals, and we're going to share in those profits, right? So when I say raising money, I just mean bringing other investors in. So that is technically a syndication. We're just letting people that otherwise didn't know that they could invest in these types of opportunities, invest in these opportunities. I mean, so this is a relatively new thing too, right? 2008, the Jobs Act is what allowed crowdfunding and sourcing of capital and allowing people to take control of their money and decide if they wanted to invest into a particular real estate deal versus the only option which they had before, which was going to your Fidelity advisor, right? Or your Morgan Stanley guy and saying, I want to get into real estate. And you could buy a real estate investment trust product that they sold. But those things are making 5-6%, right? So now that people have the opportunity to directly invest, right, it's our job just to tell the story and to find the right deal flow for them so that they can create passive income through that too. So when we talk about syndication, that's all we mean is we're coming together with a bunch of partners to buy a larger building than we would ever be able to build on our own.
What are some of the downsides or risk of going into a partnership or a syndication?
So I wouldn't call it risk. I would say the downside of it is you're not as liquid as you are in the markets, right? So if you needed your money back tomorrow from a syndication deal, typically you're not going to be able to do that. We always have an out clause with our investors. If life happens and they need their capital back, then us as the general partners can buy them out of that deal. and give them their money back, or we can bring in another investor to replace their, because you own tangible shares of an asset, right? So you own shares of a company that own the underlying asset. So you can sell those shares off if you need them. It's just not clicking a button on Ameritrade and having your money wired back into you. It might take 30 or 60 days. So illiquidity might be one of those issues if if you needed capital right away, right? So don't ever invest your last dollar into an apartment syndication. These deals are typically 3 to 5 years. And the reason for that is because you want the tax benefits, number one. You want the cash flow, right? Unlike your 401k and mutual fund investments, these things cash flow. So your money is in the asset, and then it kicks off these quarterly checks to you, which you don't get obviously from the market. And if you do, you have to take a capital gain on it, and these you should talk to your CPA about, because you probably don't. So I think the downside risk is really not having operators that do underwriting properly. That could be a downside risk. I think making sure that your interests are aligned with the operator, right? It's finding people you know, like, and trust, right? Find your tribe, invest with those people that are having success in this space. And, our investors can be as involved or as uninvolved as they'd like. We have a pretty fancy investor portal where they can log in and they can see our monthly management reports, our CapEx reports. We upload videos and photos. We have full drawings of engineering plans if you want to go pick through those. I mean, you can go in and really dissect every single piece of the deal when you're in it, or you can just lay back and get your quarterly checks. I had a buddy who just texted me a photo not too long ago, and it was him holding his check up, and it's the crisis doesn't affect him, right? And he's still getting his quarterly checks. So and it's not to say that I haven't looked at the downsides. I'm just trying to find out, more specifically how you can make mistakes, because it really comes down to human error if you're making a mistake in these types of assets, right? I mean, we're buying 220 units in Columbus, Ohio right now. And, you have 220 tenants. When one person moves out, it's not like a single family house where somebody moves out, right? It's you have 219 other paying tenants. So operationally, you could screw up, right? You can hire bad property managers or bad asset managers, but if you found your tribe and you have the right team in place, then yeah, these assets are fantastic.
What about, I tell you, one of my, I don't know if we want to call them risks or cons, but we are giving up some control. Like if we own a single family or that asset, if we want to sell it, we can get out. I mean, we could make decisions on what improvements we do, what improvements we don't.
Yeah.
Now, I would imagine in a syndication, we are giving up some control. Would you mind maybe expanding on that?
Yeah, I mean, syndications are not for people that want to build another active job, right? If you want to be a landlord on a single family house and be swapping out toilets and calling the handyman, doing all that stuff, you should do that. Our investors are called limited partners, and they're passive because the people that are investing in these typically want to have a lifestyle business or a lifestyle investment where it prints money for them. They don't have to think about it. They don't have to be involved in the day-to-day. Let me do that, right? I'm also a limited partner in some other deals. So we do the active side and we do the passive side. I mean, in Kiyosaki's cash flow quadrant, right, the most advantageous place to be is that investor side where you're not doing the active work. So if that's your goal to do the active work, then go do that. But yes, you do have to give up some control. I welcome the time that comes. That's exactly what I'm looking to do.
Okay. Are we? Are we good?
Yeah, I'll say this is kind of when you're looking at maybe potential syndications or potential companies to work with. Is there a level of due diligence that an investor should be doing prior to handing over some money?
I would.
So would I. So what would that look like?
Yeah, I mean, try to understand the story of the deal, right? And the story of them. I mean, because again, it's people that you're going to know, like, and trust. You're going to be partners in their business. So yeah, make sure that you're talking to folks, finding out where they stand on things and understanding their process. For us, we're market specific, right? We have selected markets that we like, and the reason that all of those markets are similar for us is economic drivers. So just understanding people's underwriting. Why are you getting into the Columbus market? Well, it's the 15th fastest growing city in the country, and it's now bigger than San Francisco. A lot of people don't know that about Columbus.
Wait, Columbus?
Exactly.
I didn't know that.
Yeah.
No idea.
Right. So why are we buying buildings there? Well, because there's 2 million people that live there now, and the census has it by 3 million at 2025. So that's a good driver, right? There's a lot of jobs being created. There's a lot of gentrification taking place. There's a lot of money being spent there. So why do we underwrite? Okay, so now we like this city. Now let's find a deal that we like. Why do we like this deal? The 220 units is an older guy. He's retiring. He's selling off his assets. He's not put a ton of maintenance into it over the last 5 years. So there's some upside potential there, but he hasn't raised his rents in 10 years. Right. So the average that people are paying are $565. Well, the guy across the street is full at $800. Right. So there's opportunity there. And here's where the story of the deal comes in. Right. Well, this is how we found the deal. This is why we like the deal. This is what we're going to do to the deal to make it get to here. So that due diligence, it should all be laid out in the investment packet on how we're telling our story. Right. So if people are looking at other syndicators and they're saying, what information should I have? Whatever information that you want is the information that you should have, right? I mean, we do a lot of due diligence on a lot of deals before we take one under contract, right? And we want our investor partners to know the story of the deal. We want them to be as excited as we are about this deal, right? Like the fact that we're putting a dog park in because Travis and I met from our dog 10 years ago, little things like that, right? They add to the story, they're fun, but I also get to charge $35 a month in pent rent. Right, which increases the NOI of the building, which will increase the value of it by $1.5 million. So it's not just the dog park; it's economics, right? So due diligence on where you're going to be putting your hard-earned cash is really important, and finding out who you're placing that money with and why they like those deals, really important. And I know a lot of great syndicators in this space, and I don't know a single one that wouldn't sit down and talk to any investor about any questions that they have to make them get real comfortable.
Awesome, man. Thanks for sharing. If somebody's looking to reach out to you, connect with you, where can they find you?
Yeah, so you can go to freefromwallstreet.com and you can download a PDF, which is basically the 5 things your financial advisor doesn't want you to know. And you can find us there, find us on our podcast. We're all over Facebook. And if you want to email me directly, it's Steven with a V at integrityhg.com.
Awesome, Steven. Thanks. We'll be sure to include those links in the show notes. And man, awesome. Thanks for your time. Appreciate it.
Yeah, great talking to you guys. Thanks for having me on.
Yeah, thanks, Steve.